Good morning. It's Friday, the 20th of September, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. The take. While many around the country were rightly upset and angry over the death of a 26-year-old chartered accountant who passed away complaining of exhaustion and overwork at her firm, S.R. Bartley Boy, based out of Pune, there was another story that caught my eye. Now, this was of a 19-year-old delivery boy working for a food delivery company in Chennai, who died by suicide in his residence on Tuesday. The Indian Express said the death was due to consequences he faced following an altercation or a quarrel with a customer over a delayed grocery delivery, in turn caused apparently by difficulty in locating the house. This 19-year-old boy was a BCom student balancing his studies and part-time work. Maybe he would have wanted to study on and become a chartered accountant, exactly like that Pune girl, as many BCom students aspire to. But that obviously did not happen, and the story turns sadder as you read on, because the lady was so upset or matters went so out of hand that she not only berated him for being late but then filed a complaint with the delivery platform, who in turn are believed to have taken some action against the delivery boy, according to the police quoted by Indian Express. Now, there is much commentary right now on the nature of work or overwork. Be that as it may, the challenges faced by knowledge workers often get more attention than those faced by delivery executives or delivery boys like the one we just spoke of. Remember, it's not just about being on time for these youngsters, but also battling extreme weather conditions from record temperatures to incessant rainfall. And rarely do they even get that additional tip. A study by Bank of Baroda Research last month said the employment seen in India's corporate sector, as represented by a sample of 1,196 companies, was not too encouraging. Based on data reported in balance sheets, BOB said that job growth for the sample was just 1.5% in 23-24, that's the last financial year, compared to about 5.7% in the previous year. Moreover, says BOB research, the top 5 companies with the highest headcount actually employed less people last year than they did the year before. So employment levels, at least for these largest companies, fell over the last 2 years. It's very likely that that delivery boy does not even figure in these statistics because these only cover the unorganized sector, whereas the Pune girl quite likely did. And yet, their challenges were somewhat similar. For both of them, the stress of holding on to the job and working hard would have surely strained their physical and mental faculties, as it clearly did. They're obviously not alone. Jobs are fragile in India, except for a few talented and perhaps lucky youngsters. No wonder millions line up for thousands of government jobs because they provide a sense of security for themselves and their families. It's also evident that even for those within jobs, particularly in the private sector, there has to be a better and conscious understanding of workplace pressure and what it can do. There will surely be much discussion of working conditions in consulting firms, but will there be of workers in the gig economy or construction workers who toil in the most difficult physical conditions and also form the largest chunk of employees? Because the cumulative effect of the macro environment, which is the economy, and the micro environment, which includes the working conditions, has never been so profound or stark. As we rightly debate what led to that tragedy in Pune, we should also think about the millions who toil away in these extreme weather conditions, including those who almost kill themselves, just so that we can eat our pizza when it's hot. And our top stories and themes of the day. Wall Street jumps and could drive up Indian stocks further on Friday. The rupee recovers to a 2-month high. Gold prices hit all-time highs too. Where could they go next? And can a grace period for microfinance loans improve the chance of repayments?
This is the Core Report with Govindraj Ethiraj.
Stock markets brace for another rise. Stock markets in India hit fresh record highs on Thursday, thanks this time to expectations of increased foreign portfolio flows after the United States Federal Reserve cut interest rates by 0.5 percentage point. Interestingly, the broader indices in the mid-cap and small-cap space were down, with analysts saying that now there could be fresh shifts back or to large-cap stocks. Foreign institutional investors usually seek wider horizons when US interest rates go down, and the lower the rate, the further they go, particularly into emerging markets, or at least that's the belief. The government-owned power producer NTPC rose about 2.5% after its green energy arm filed for a $1.2 billion initial public offer, according to Reuters. So there's more IPOs coming your way. Reuters also said that telecom companies such as Vodafone and Indus Towers dropped 20% and 9% each after the Supreme Court rejected their plea to correct alleged errors in calculating the license fee they owe the government. So the BSE Sensex added about 236 points to close at 83,184 after hitting a record high of 83,773 during trade on Thursday. The Nifty 50 touched an all-time high of 25,611 before closing up 38 points at 25,415. Wall Street was pumped up a day after the Federal Reserve's interest rate cuts, perhaps predictably so. The Dow Jones Industrial Average was up about 485 points overnight. The S&P 500 was up about 1.6%. The Nasdaq Composite was up about 2.4%. The CNBC reported that traders got some validation that the Fed was engineering a soft landing for the economy on Thursday as weekly jobless claims fell by about 12,000 to 219,000, which was below estimates. So the interesting part is this. Tech stocks are also rallying because the rate cut has now spurred investors to return to a risk-on mood. I wonder if that risk-on mood could generate or trigger more capital flows, including to India and not just in markets, but in other spaces as well. The rupee hits a 2-month high. The Indian rupee hit a 2-month high on Thursday thanks to likely portfolio inflows that we touched upon and a rally in the Chinese yuan after the Federal Reserve's 50 basis points interest rate cut, according to Reuters. The rupee ended at 83 rupees 68 paise against the dollar, which was up very marginally from its previous lows of 83 rupees 75 paise. It had hit a high of 83 rupees 57 paise in the session, its strongest since the 18th of July. The offshore Chinese yuan was up as well, and that was at its highest level since May 2023. Oil prices jump again. Oil prices are now rising again as overall risk levels rose, tracking increased tensions in the Middle East and the steep interest rate cut by the Federal Reserve. Brent futures climbed towards $75 a barrel after closing little changed on Wednesday, while West Texas Intermediate was above $71. Bloomberg said that European stock futures had gained alongside Asian equities as the Fed's move reinforced expectations that the US economy will avoid a downturn, which could obviously mean that oil or demand for oil could stay up. Gold prices jump as well. And more on the Fed rate impact, and arguably it does extend to many asset classes. Gold prices climbed further on Thursday after hitting record highs on Wednesday. Spot gold rose about 1% or a little more than that to about $2,586 per ounce after hitting an all-time high of $2,599 on Wednesday, according to Reuters. So the bet, of course, is that there will be more interest rates coming soon, which makes gold more attractive for its capital appreciation as opposed to holding a low interest rates instrument. I spoke to Ajay Kedia of Kedia Advisory, a trading firm based out of Mumbai, which specializes in commodities and metals, and I began by asking him how gold prices were looking from the India vantage point.
2024 is going to be a remarkable year because already up till now we have seen gold prices has gained very sharply. The perfect blend, or we can say perfect environment, has been there as of now. We have seen inflation is slowly and steadily coming down in last 6-7 months. We have seen crude prices came down, base metal prices came down. So I think Fed was just looking that if the inflation comes down, then they can take steps. Secondly, central banks are continue to be buy from last couple of years. Even ETF buying, or we can say investment buying, was been there. So I think the data point what we have seen in last couple of months, industries are not going very well. To boost them, to boost economy, we have already seen ECB, Bank of England, every central bank has started taking the action. I think 0.25 rate cut was bit in line of expectation, but 0.5 rate cut was very surprising to the market, and I think that is the perfect blend for gold to rally from here.
At this point of time, considering that we're already at record highs, how far can it go and how long?
Let's say 2007, 2019, 2020, whenever this type of rate cut comes, we have seen on an average in next 1 year period, the rally in gold prices to the tune of, let's say, 10 to 20% has been already been seen. I think no doubt the rally has been quite impressive in last 6-8 months. We have seen last year around $1,700. Now we are at 3,600 mark. But I think the fundamental are still remain bullish with the geopolitical tension still prevailing with us. So I think the scope for this year, and we can see a level like 2750. But next year that we are expecting 3,000 would be the level one can see in international market.
How does this link to, or is it linking to silver prices as well?
Silver is been also known for poor man gold. Whoever left rally in gold try to get back with a silver, and silver is having a 12 property of bullion also, but base metal also. No doubt, up till now, silver was bit underperforming because of industrial consumption of green energy consumption was slightly challenging. But with the rate cut, we expect the demand, industrial demand would be definitely improving. We have already seen Indian import is been quite high. Looking to the gold silver ratio, we expect silver should outperform more. Even in last 1 month period, silver has outperformed. So I'm more bullish on silver. Maybe we can see level like $38-40 in next 1 year period for silver in international.
The buying that you see in silver, I mean, what denomination does it usually happen? I mean, what is the retail part and what's the institutional part?
See, in last few decades in India, definitely there is a charm of buying silver as a slight investment or a rituals day. But as an investment, we have never seen silver as a more attractive bet. But in last couple of years, with the introduction of ETF, people are now looking silver as an investment. Prior to this investment, we can say industrial demand was quite high as compared to investment demand. But in last couple of years, with the introduction of major products, we have seen investment demand has increased in silver.
Recent union budget reduced import duties from 15 to 6% on gold. Obviously, that has triggered a demand rise. So, do you see that sustaining? I mean, in general, apart from all the other factors that you pointed out?
Buying gold and silver in India is having a inverse relation. Whenever there is a drop, generally people avoid. But whenever there is a rally, people more buy. So I think that drop or duty adjustment was a very good opportunity to buy, and still looking to the fundamental and rituals and festival demand, upcoming festival demand. All this I think is an attractive bet to buy silver and gold both. And even I think as equities earnings are being quite high as of now. So diversifying their portfolio in gold and silver would be a vital decision at this time.
Right, Ajay. Thank you so much for joining me. India is going to be the third largest economy. India is on track to becoming the third largest economy in about 6 years' time, driven by a projected annual growth rate of 6.7% this fiscal, according to S&P Global, which released a fresh report on Thursday in Mumbai. The report also said that with an 8.2% growth last year, continued reforms are crucial to improving business transactions and logistics, boosting private sector investment, and reducing reliance on public capital. It said that equity markets are expected to stay dynamic and competitive due to strong growth prospects and better regulation, and foreign inflows into Indian government bonds have surged since the country, that's India, joined major emerging market indices like the JP Morgan one. On the flip side, it also pointed out that to maximize trade benefits, India must develop infrastructure and geopolitical strategies, particularly regarding its extensive coastline. And here's the interesting part, and something or other, a figure that you may not have noticed. Nearly 90% of India's trade is seaborne, necessitating a robust port infrastructure to manage increasing exports and bulk commodity imports, S&P said. Can a grace repayment period drastically reduce microfinance loan defaults? So here's the larger problem. Women are at a disadvantage when it comes to taking loans, or the terms are not the same as men. So the concept of microfinance was pioneered in the 1970s by Muhammad Yunus, founder of Bangladesh's Grameen Bank then, and now chief advisor to the interim government there right now. The idea was to lend to groups of women, with the entire group responsible for repaying loans made to individual members. There are many more interesting insights over the years on how these groups have evolved and the larger community benefits. Microfinance itself, of course, has spread wider and become part of a larger approach to small ticket loans to poorer sections of society. Many of these initiatives have, however, not worked, particularly for the lenders, including in India, where there have been problems with microfinance loan portfolios. For instance, the Economic Times quoted an official last month from a microfinance association that there was no foolproof way of measuring household income for borrowers in the microfinance sector, and that this was very subjective as of now because it depended on the feedback from the borrowers, and field officers were under pressure to expand business. Thanks to which there is or was a possibility of over-reporting of income, resulting in over-lending and thus the consequent problems. Now, this is, of course, in the context of renewed strain on microfinance portfolios. But while the sector is evolving constantly, one of the approaches was to have grace periods for the loan repayments to kick in. Rohini Pande, the Henry J. Heinz II Professor of Economics and Director of the Economic Growth Center at Yale University, says they ran randomized controlled trials in which some client groups received the standard loan and others received loans with a 2-month grace period before repayments began. This small change apparently had outsized effects. After 3 years, households with more flexible grace period loans reported higher business profits and household income. Now, this is, of course, a trial, but the findings are useful in gauging borrower behavior, possibly for even other types of loans. Potential innovations like these in the area of loans for women can, of course, have much greater multiplier effects. I spoke with Rohini Pande on the larger theme of microfinance, and I also asked her how she saw this grace period experiment working out.
When microfinance started, a key feature that people were concerned about organizationally was whether, poor women who are making loans without collateral will actually return those loans. And so as a result, the repayment schedules that came up were very conservative. So the typical microfinance organization asks for repayments starting 1 or 2 weeks after the loan is given out and continues on for usually less than a year. And I think in talking to loan officers and also to clients, it sounded like what ends up happening, therefore, is that the decision to make a loan is not given out on the basis of how profitable this particular loan would be, but actually whether the borrower already had capacity based on their activities to start repaying within a week. It also pushed borrowers to use this money much more for working capital than for making investments. And so that got us thinking about what if actually microfinance took seriously the idea that some of what entrepreneurship needs is venture capital. But how can you do it in a way that, is going to be acceptable to microfinance lenders who, because of the requirements to raise money in the capital market, tend to be quite conservative, and there's any modification that I think will reduce repayment rates. So we worked with a microfinance lender in Kolkata and came up with this idea of just delaying repayments for the first 2 months. We called it giving it a grace period. That's only one form of flexibility. And I should say, since our work, there have been several other papers which have evaluated different forms of flexibility. So, for instance, you could tell the borrower you have to repay 12 times, but you can decide how to stack it up, or you can take a repayment holiday halfway through. What we found 3 years later was very significant increases in microfinance profits. So this flexibility gave borrowers the chance to just invest in activities that had a longer term return, and led to capital returns that were in the range of 12 to 20%. Since then, we've actually done an 11-year follow-up, and we actually find that these income gains are also getting invested in the longer run in their children's human capital. And we find a significant increase in the fact that the children go to college. So this not just increases household gains in the short run, but also leads to intergenerational benefits.
Do you feel that microfinance companies could start applying this more actively? I mean, you said that this was one firm that you worked with in Calcutta, but do you see this rolling out further, or are people waiting for more evidence?
So I think there's certainly quite a lot of evidence at this point. And so I think it really is two parts. One is kind of the regulatory aspect of what you're allowed to do. So for instance, when we worked, a microfinance loan could not extend beyond a year in totality. So even if you had a grace period, we had to keep it within a year. So one would be to, and I don't know what the current situation is, so one would be to work with what is regulatory feasible. But I certainly think the main lesson, which is that you can sandbox and try out product design innovations and evaluate them, is very useful. As you know, there was a set of studies suggesting that the classic microfinance contract does not reduce household poverty on average. And I think findings like ours suggest that actually product design innovations may actually change this result. And microfinance in India is booming. So I think there's certainly value to thinking about how you can actually make it work better for the clients.
Are there, from your own studies, any insights on the kind of borrowers and who is, let's say, more likely to be creditworthy as opposed to others?
So I think, our study didn't look so much at the selection margin. So because we were trying to isolate this effect, what happens when you change flexibility, we actually went to great lengths to ensure that the randomization into the type of loan you get happens after the pool of microfinance clients was selected. I think we can possibly speak a little bit to the type of clients who were more likely to default under a flexible loan rather than a regular loan. The main thing that matters is, which I think is no surprise, is shocks, is things like health shocks, income shocks, and so on. But since then, I think there's been more work trying to understand who selects into what type of loan. There's certainly a concern that when you allow for more flexibility, we did see some slight increases in default rates. And so you may be concerned that, which is what I think loan officers talk about a lot, is that, you don't instill discipline of repayment very early on, and that has some longer term effects. But I think if you could think of a model of kind of cross subsidization, it's certainly worth it because the change in the returns income gains is large. So you could imagine what I think a lot of microfinance institutions do is pay a lot of attention to who they're graduating to even larger individual loans. And I think that's where one can actually use these findings.
If I can take a step back and ask you a little more about the efficacy of microfinance or loans and credit as a tool for empowerment, for income creation, growth, acceleration, and so on.
I think, in general, I'm in favor of microfinance. I know after, as I said, the findings of the classic microfinance product didn't have returns, there was some amount of questioning of whether microfinance is the right way to go, or we should just move towards kind of model of grants. And, BRAC in Bangladesh, for instance, has a very successful ultra-poor program that is a bundled commodity but gives grants. My own sense is that if you do the numbers at scale, you're never going to reach the numbers of poor people you want to reach. So in that sense, loans is a much more equitable tool in that it's, conditional on make it through screening. It's available to everyone and it's available to the poor. Microfinance has this great feature that doesn't ask for collateral. And so I think those two features make me think that, microfinance is a very valuable tool, but we need to continually be redesigning it. I think the Indian microfinance and Indian regulators have arguably been more conservative than several other countries. And, that can be a good thing at the time of, say, a financial crisis. But I think there's certainly value to be a little bit more, more willing to try. Now, especially, I think the big new frontier is digital loans. How are they going to work for poor households? Digital loans can be very flexible, or you can really require repayments every day and freeze someone's phone if they don't make that repayment.
Are you working on anything in this space right now? And is there any newer areas that you're diving deeper into following these studies that you've done, which may emerge in the future?
So I think I've been very interested, as I said, on kind of digital finance and how is that going to work. One of the things we see is very large gender gaps in digital finance. It could be, even use of UPI or PhonePe, all the way through to any kind of trying to create a digital wallet. So I think thinking about the gender-digital divide is something that we've been working actively on. And I think it's good to reflect on that relative to microfinance, which, may have had a very specific model of loan officers turning up in the village and having group meetings. But those all were important forms of empowerment. Women left the house, they made friends. We have another paper showing that the frequency of repayment meetings not just affected women's trust and friendship network, but actually affected their ability to risk share. As we move increasingly into a world of digital products, if women are already disadvantaged to start with, I think we need to be very careful to make sure they don't get left behind. There, I think kind of the standard should be what microfinance achieved.
Rohini, thank you so much for joining me. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.